Pivot points. In this video you will learn what pivot points are, why they are important, how they are calculated, how they are used, how to increase the probability of a trade setup. Pivot points are a way of determining key support and resistance levels. Before computers and charts became a key tool that traders used so effectively, floor traders use calculations based on the data from the previous trading day to determine key buying and selling levels for the current day. They are still extensively used today, as they can act as support and resistance levels, which are very useful in determining entry and exit points. There are different types of pivot points that are calculated using previous market data. Most commonly, the previous day's open, high, low and close are used. The previous session's data is used to calculate the main pivot point, the point at which the market is said to pivot around. Once this has been calculated, the main pivot point is then used to calculate the other pivot points. The pivot points above the main pivot are labelled as resistance pivots, notably R1, R2 and so on. Pivot points that are below the main pivot are support pivots labelled S1, S2 and so on. When trading using pivot points, the general rule is if the price is trading above the daily pivot, the market is going up and so our bias should be long. The main resistance levels are R1, R2 and R3. But all pivot points can be used as both support and resistance levels in certain instances. For example, if the R1 pivot level gets broken as resistance, it can then act as a potential support once price moves back to it. If the price is trading below the daily pivot, then our bias should be short. The main support levels are S1, S2 and S3. If the S1 pivot level gets broken as support, it can then act as resistance when the price retraces back to it. We can also use pivots as targets for taking profits. Targeting the next pivot point can give the trader a consistent way of taking profits. For example, if we bought at the daily pivot, we could take profits at the R1 pivot. As with all support and resistance levels, there is strength in numbers. The more pivot points that we have lined up at a certain area on a chart, the higher probability there is of a price reacting to that area. In this example, we have a weekly pivot point that lines up with the daily R2 pivot point, increasing the probabilities of price reacting to this area. So far, you have learned that pivot points can act as very strong support and resistance levels, and are calculated using the previous period's open, high, low and close. As with traditional support and resistance, once price breaks through a pivot point that was acting as support, it can then be used as resistance. And once price breaks through a pivot point that was acting as resistance, it can then be used as support. Pivot points can be used as targets once a trade has been placed. There is strength in numbers. The more pivots that cluster together on the chart, the stronger the support or resistance level will be. Understanding leverage. In this video you will learn what leverage is, how leveraging works, what the dangers of leveraging are, how to limit the dangers of leveraging using money management, what maximum leverage and true leverage are. Leveraging is a mechanism that allows you to trade larger position sizes than your trading account would usually allow you to. The way in which leveraging works is that your broker effectively lends you money, and you're able to buy or sell much larger amounts of currency than you originally would with just your own trading capital. When a trade is opened, for each pip movement, there is a fixed amount that the trader will make or lose. For example, when trading with a standard lot on a major currency pair, each pip movement is worth $10. This is because when you buy a standard lot, you effectively buy 100,000 units of a currency. And so a single pip movement, which is 0.001 of the currency, is worth $10 on major currency pairs. Once you multiply 0.001 by 100,000. Most traders, especially when starting out, do not have $100,000 to purchase a standard lot with, and so a trader can make use of leveraging. So with a leverage of 100 to 1, a trader can trade a standard lot with just $1,000, and the broker effectively lends the trader $99,000 to make up the rest of the standard lot. The trader will then still gain or lose $10 per pip, but with just a $1,000 starting capital. When the trade is closed, the profit or loss that has been made will be added or taken away from the trader's account, and the money borrowed is then effectively returned back to the broker. So when you are trading with a leverage of 100 to 1, it means that you only need $1,000 to trade $100,000 worth of currency. This will amplify gains from the trade. However, using leverage will also amplify losses. It is clear that one of the biggest dangers facing a new trader when using leverage is to hold no regard for risk management. Without money management, leverage can quickly reduce a trader's capital to practically nothing. If you trade a standard lot with only $1,000, then a loss of 50 pips will result in reducing your account down to $500, wiping out half of your account. Incorporating money management with leverage will ensure that the amplified losses will not wipe out your capital. So if you make sure you only risk a maximum of 2% of your account when leverage has been applied, your trading account will not succumb to the exaggerated wins and losses from individual trades. What do we mean by a 2% risk after leverage has been applied? Let's say that you have $15,000 and the trade you're about to take has a stop loss of 20 pips. We know that the total amount that we can risk is $300, because 2% of 15,000 is 300. We know that if we trade a standard lot, then each pip is worth $10. In order to trade a standard amount, you need to apply leverage with a $15,000 account. If the trade has a 20 pip stop loss, then the total risk for the trade is $200. This means that we can actually trade a standard amount. However, because the total risk after leverage that has been applied is less than the maximum risk allowed for this account, we can trade a standard lot for a trade that has a 20 pip stop loss with a $15,000 account. True leverage is the amount of leverage applied to any given trade and is calculated by dividing the size of the position by the trading account balance. So let's take the example of buying a standard lot. If you have $100,000 in your account and you bought one standard lot, which is 100,000 units of that currency, then the leverage would be $100,000 divided by $100,000, which is 1 to 1, effectively no leverage is applied. If, however, you only have $10,000 and you bought a standard lot, then the true leverage is 100,000 divided by 10,000, which is equal to 10 to 1. So the leverage for this trade is 10 to 1. The amount of leverage that is available to a trader is called the maximum leverage, and this cap is set by the broker. Some brokers offer 500 to 1 leverage, but many offer 100 to 1. So far, you have learned leverage is where a broker lends you money to control a larger position size than your trading capital would allow you to. By using leverage, you can amplify your gains, but you can also amplify your losses. When using leverage, it is essential that you incorporate money management, because the amplified losses can wipe out your entire trading account. You must never risk more than 2% of your trading capital on any trade after leverage has been applied. The amount of leverage available to a trader is set by the broker. And finally, the true leverage is the leverage for any given trade, and it is calculated by dividing the size of the position by the amount in a trading account.